Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be going over the M1 Finance Roth IRA portfolio, and we're going to be going over a new sort of idea that I had in my head just within the last few days, watching a stock run up over 20% just within the last week. This kind of gave me the idea to maybe use M1 Finance to take those gains and reinvest just the gains elsewhere in the portfolio into stocks that have been hammered in the opposite direction, say a stock that's gone down over 10% just within the last week. So I would take gains from one stock and move them into another and take, it would still balance out the portfolio. So that's what we're going to be going over in today's video. If you are brand new to the channel, hit that subscribe button below. If you have had this idea or haven't had this idea, let me know in the comment section below. Let me know what you think of it. And if you do like the video, hit that thumbs up button below. I highly appreciate it. So what exactly do I mean? Well, if I take a look here at the 1 week chart, we can see here that a new stock here I added to my wife's Roth IRA just a few weeks ago is ticker symbol ABM. This is the ABM Industries Incorporated. It was a brand new stock I added to my wife's Roth IRA. I believe it was at a good position to buy, had strong financials, added in there, and just over the last week, it is now up over 20%, making $51.34 in gains. It doesn't go ex-dividend until January, so that still gives me a little bit of time to capture the equity here that I made just in the last week, roll that into another stock that may be going ex-dividend here soon, or that has just been hammered here within the portfolio just within the last week. So this is something that's fairly new to me, and I kind of wish I had maybe thought of it a little bit sooner. Earlier in 2018, I had Cisco, Apple, AbbVie, a few others here that were up in the portfolio by some 20 to 30%. So here we can look at the all, and we have quite a few stocks here still in the green, ABM being number one, and it's only been added in my portfolio just the last week or two. So it's already outperformed Pfizer. We can see Cisco has gone down almost, it's at 5% now. It used to be up in the portfolio some 30-35%. So kind of looking at this, how can I take advantage of M1 Finance's free trades? I can also reinvest my cash on balance. These are just a couple dividends that I was paid out this week. So this week already, I've made $5.02 from AbbVie, Stanley Black & Decker, and Kellogg. So dividends right there, $5 free back into my portfolio, able to be reinvested elsewhere. Now, okay, so here's what we're going to do. This is my plan to take advantage of these quick gains. Now, I'm only doing this with stocks that have ran up very quickly in a short amount of time. I believe this stock is going to be falling back. I don't know if it's going to be falling back 5%, 10%, 15%. Who knows? But at this time, it has ran up over 20% in a single week. So with the advantage of M1 Finance, I can go ahead and select this stock, sell a piece. So here, my gain is currently $51.31. So I can go ahead and say that I want to sell off $50 of this specific stock. I can go ahead and hit continue and confirm what this is going to do on Friday, or when you guys are watching this video. It's going to sell off $50 of shares of this stock. It's partial shares. Now, at that time, I will have $55.02 to be able to reinvest back into the portfolio. Now, I don't want to increase my risk by reinvesting those funds into stocks here that are more towards the bottom of having dividend growth and have high payout ratios. So what I've actually done here, and as I've looked at a couple stocks here, Lowe's, for example, is another one I've added in recently, but a utility company here that has been Edison and Southern Company. So Southern Company is currently down. It has 16 years of dividend growth. It's a utility company, so yes, it has a high payout ratio, but it's still a strong company overall. And utilities are sort of that safe play right now. I want to build up the equity within these portfolios, these specific stocks. So what I'm going to do is I've sold off $50 worth of ABM. I've looked at the new buying power. So ABM, I bought it with a yield on cost of 2.62. It's now trading at a current yield of 2.25 if you were to buy back into that stock. Southern Company, I bought it at 5.12% yield, and now at a current starting yield, it's offering me a 5.32% starting yield on that stock. So I'm able to kind of move equity from one position into another, capture my gains that I've made within one stock and roll it into another, giving me an decreased unit cost, and increased yield on cost, and it'll basically increase my overall dividends payout with the same amount of equity, because all I'm doing is taking the equity that I've made within one, rolling it over to another, and kind of going from there. So I don't want to make it too confusing there, but I think you get the gist of it. So let's go ahead and make our buy on Southern Company. So on Friday morning, I'm going to go ahead and initiate this. Currently, Southern Company just within the last week is down 5%. Good discount there. Better than my current overloaded stock there at 20%. And now I can go ahead and place $55 in, $55.02. That's correct. We can go ahead and do that and continue. So on Friday, what's going to happen, it's going to sell $50 of my currently over positioned ABM. It's up 20%. I don't mind selling it off here because I've made 20% just within the last week. And I want to roll those gains, just the gains, over into a stock here that has gone down 5% that I believe is a safer. It's still mitigating my risk. It's still a very strong dividend growth company. It's a utility company. And kind of going forward, I may do this a little bit more. I just thought it was kind of a neat idea to kind of capture my gains, because earlier in the year, if I had captured and taken advantage of doing this with Apple, Cisco, I could have rolled some of Apple's profits. I was up some $300 just in that position alone, or I don't know if it was $300 in this portfolio, but I know it was up 30% at one point, 35%. If I had rolled those gains into a stock such as Caterpillar, or a couple of these other ones that were down for the year earlier in the year, that would have increased my starting yield for that position, plus decrease my unit on cost for those positions. I wouldn't have lost any equity in the portfolio, because all I was doing is selling off the gains that I made out of one stock and kind of rolling it into another. So in this downturn, I probably will continue to look for stocks that run up very quickly, say 10 to 20%, take some of their earnings, shave them off the top, and kind of roll them into stocks that I could be negative. Right now, I only have a few positions that I'm actually up in the portfolio, and I have quite a few more positions that are actually in the negative right now, offering me a very nice starting yield in many of them. So for example, Altria currently has a starting yield of 6.52. We have Simon Property Group has a starting yield of 4.85, where my starting yield, or my actual yield on this company, is 4.69. So there's a couple instances here where I can work on increasing my overall yield of my portfolio. I believe right now, if someone looked at my stock and bought into it, it would start right around 3.74. But my actual average yield of my portfolio currently sits at 3.42% as far as what I have bought into so far. Now, I currently have it sorted by the stocks here that have paid and grown their dividend the longest. So I feel a lot more comfortable rolling my dividends, my equity, into positions that have grown and raised their dividend for the past 10 plus years. So I only hold a few stocks here that have actually not paid or grown a dividend for more than 10 years. I have Altria, Caterpillar, Pfizer, Simon Property Group, Avery Dennison, Cisco, JP Morgan, and Apple. So of those, I'm not too worried that either of them will either cut or discontinue their dividend. JP Morgan, I don't think they will continue to raise or pay out a dividend if we were to go into some hard times. So right now, I am just going to continue to look for stocks that run up very quickly, roll the earnings into some other stocks, and kind of go from there. So that is all I want to kind of go over in this video. And let me know in the comment section below, what do you guys think about this? Do you think it's smart to remove positions, or not remove? All I'm doing is removing the gains that I've made over a short amount of time and rolling that into another stock that has been hammered here in a short amount of time, that is still a low risk, high dividend growth, safe dividend growth investment. I'm not selling out of any positions. I'm just rolling gains from one position into another to kind of take advantage and capture those gains, increase my yield on cost on specific stocks, increase my overall dividend payout. So if you did like the video, hit that thumbs up button below. If you are brand new to the channel, hit the subscribe. Highly appreciate it. Let me know in the comment section below. Do you agree with me? Do you not agree with me? Do you disagree with me? M1 Finance, free trades, no fees, partial shares. It all feels sort of win-win-win. And I know I'm going to be capturing a gain of 20% and rolling that into a loss of 5%, a very discounted stock there that I believe will benefit me in the long run. So that is it for this video. Thank you all for tuning in. I will see you next time. Have a great day. Bye.